go. So it's another glorious day in the markets. The Russell is collapsing. The Dow is selling off a bit. That's not the Dow. Nobody. There we go. The Dow is selling off a bit. The S&P, we have a nice pop in the Nasdaq that's fading out. Everybody else is boring, nothing exciting going on here. So we're not going to really talk about that too much. Okay, you know what? I'm going to write that CC cleanup suggestion down because we do have to do something to fix this thing. But like I said, it's not that. I got to find where those files are for the webinar and delete them, I guess, because I'm pretty sure it has no effect on what's up on the web. So they're taking ridiculous space. Anyway, so things are moving along nicely enough. Let's shrink this thing. We'll take a look at where we are. Go to today's post. And as I said, market swings are getting wilder, and that's happens before a crash. We got to be very careful. See where things end up. Can't take anything for granted on these things. Last week we had, right, 8.5. Yeah, last week we had 18.6, and now we're at 20.4. So basically 2 million. It's 10% since last week. It's actually slowing down. It was 15% at one point in a week. So I guess you can say 10% is good. But it sure as hell isn't great. You really don't want to see 10% weekly growth. I don't think the US is actually getting better though. Our spread slowed down because we're only at 164 deaths. We were at 140, 150 a month ago. So I don't want to say it's encouraging, but it's better than nothing. But this, I'm not going to go over it again. The school opening thing is insane. So we'll see what happens. But I wouldn't say it's getting worse. I mean, I guess we look at the US by itself. Look at that, 5.1 already though. Wow. We really do pile them on every day, don't we? So here's the we reopened here, right? I mean, on Memorial Day or whatever it was. So somewhere around 5:20 something was when we reopened. We were doing really good. We reopened. It doesn't seem, you'd think it doesn't have an effect. It goes almost a month before you start seeing it, but then boom, you can't stop it. And by the time we were here, we went through July 4th also, and nobody really did anything about it. By the time July 4th was over, though, they started saying, well, you know what, that was kind of a mistake, obviously. And now we went back to a lockdown mode. So going back to a lockdown mode. Now here, don't forget, we were in lockdown here. So that's what you're going to expect to see. It isn't going to go down to here. It's going to go like this and flatten out around here. So we're still going to be getting that massive amount per day. And like I said a couple of weeks ago, I said there's no stopping this. I mean, you can slow it down, but it's basically still spreading out of control. And the reopening schools is the next giant. We made this mistake and everybody let it happen. Now we're going to make this mistake in the schools and everyone's going to let it happen. So I'm a little concerned, but what are you going to do? What are you going to do? We're doomed. I think there was a news article today. Let's see if we get to it. I don't really want to talk about that stuff since it's kind of depressing. So let's just pretend everything's fine. What was I looking for? Oh, here's Gupta. He says, do not go back to school. Trump ruled out socially distanced rallies. You can't have empty seats. Oh my God. Cases 500,000. There was, I don't know. Somebody went back to school and 1 million people, like I forget, it was something horrible. Some school got horribly infected, but when they reopened in one state, doesn't matter. It's a bad idea. I don't need to prove it's a bad idea. Well, apparently I do, unfortunately. I mean, I kept saying that it was a terrible idea to reopen in around Memorial Day, and nobody listened, and it turned out to be a terrible idea. So I guess it doesn't matter if I say something's a bad idea. Not enough people listen to me, which is a freaking shame. Sometimes, I mean, it seems like a really obviously bad idea to me, but so did reopening for Memorial Day seem like a really bad idea. This is the worst idea, though, I think, because you're not just infecting the idiots who go to the bars and the beaches and stuff and think that that's okay, even though the day before they were wearing a mask, but just because it's a holiday, you take your mask off and go have fun. Obviously, those people are a problem in the gene pool in the first place. But when you're talking about, you're talking about now that I have to send my child, I legally have to send my child to school. Thank God, my kids are going to college, but even then, they have to go to college. I told them both they should take the semester off. I said, why don't you just take the semester off and not do it? So you don't have to go. You're only going to be a year behind. It's not a big deal. But they don't want to desocialize and such. But I'm not happy about it. I don't think it's a good idea for them to even be in college. And but they, look, they're adults. They can make that choice. And I'm not sure I would have done differently when I was a kid. I would have been like, oh, I can take a virus, blah, blah, blah. But, it's not a choice for parents who have kids in school. It's legally, they have to put their kids into school. And you're just risking infection no matter how careful you can be. Now you have to count on all 600 parents that go to that school being just as careful as you are and mixing their kids with your kids. And every time your kid comes home, they could be like a walking virus bomb. What the hell kind of thing is that to do? We need a better solution than that. We have no solution. We really don't have any solution at all being put forward. So that's bad. This didn't start today. This started yesterday. So look, at this point, with the market as high as it is, with things the way they are, I'm not confident to keep a lot of stuff in the market. Now we're only pulling these trades at the moment, but next week we're going to, oh, for God's sake, go away. I don't know, pick a time. How about 4:30? I won't even be watching this. Okay, is that it? No, that didn't change it. Oh, I see, check. There you go. Thank you, I guess. Pick a day, Saturday. Don't do it today. All right. Just get it done. All right, where were we? So anyway, so yeah. So we're gonna go through all our portfolios, and look, we go through our portfolios a lot. I have tried for 3 months in a row to cut our portfolios down, but fortunately or unfortunately, they do really well. There's not much to cut. Earnings portfolio is up 78%. It's got its own hedge. Not too worried about them. Butterfly portfolio, 22%. That might not be right though. So these Disney calls and some of these things haven't been adjusted properly, so that needs to be cleaned up. I don't think it's that low. Dividend portfolio, ooh, well, flat. Not exciting. Futures now portfolio, 56%. And Boca, we killed that portfolio, but had we not killed it, 28%. Money Talk portfolio, 20%. Who's dragging that one down? Oh, Tanger Family Outlets, Factory Outlet. Well, that's surprising. Tesla not doing too well. That's interesting. So they're getting dragged down a little bit. But the long-term portfolio, crazy. It's up 104%. And that means $1 million basically, right? Yeah, $1 million, 1021. And the short-term portfolio is 336, so that's 436, so just a little under 1.5 again. We were at 1.5 like yesterday, the day before. It changed a little bit. You know, that's the problem though. You know, when your portfolio balance is going up and down 100,000 in a couple of days, that's dangerous. And you got to say to yourself, when you're 1.5 million, when you started with 600,000, you got to say to yourself, boy, this would probably be a great time to quit. We're up 150% for the year in the two portfolios. So I keep trying to cash them out, but we keep managing to make more money. So it's not an easy choice, but you know, at a certain point, it's just ridiculous. I mean, you know, it doesn't make sense, and you can't just keep going like this. So anyway, so yesterday, so let's take a look at what we did go through position by position on this. Back on March 12th, we did crisis trading, and that was when I was on Money Talk, and I picked all these different trades for the, you know, we were crashing but not crashed completely. But I thought it was a good time to start selling puts. What do we do? Look, what do we do when the market goes down? What changes in the environment when the market goes down? Well, when the market goes down, the VIX goes up. Where's my futures? So index is VIX. So in other words, here was the VIX all last year, all this year. Then in March, this is the beginning of March, March 1st. This is, you know, what is the point of having the stick if the stick is not going to tell you what day it is? Why? Well, look, it tells you the 45 over there, but it doesn't tell you the freaking date. That's so annoying. Oh, here you go. Okay, sorry, it's over there. Too much information. So here we go, March 12th. So on March 12th, okay, this is long after it goes past. So the VIX went over 20. We didn't trade. The VIX went over 30. We didn't trade. At 40, though, I start looking at puts and going, see what happens. I start looking at puts and going, the VIX is not likely to sustain 50. So at that point, I didn't, and it wasn't that I thought it wasn't going to go higher. It's just that 50 is a really good point historically to sell short calls and short puts because it's a very high VIX. How high is it historically? Well, here's 50, and here's the last, you know, here's the last 2 decades. So that was a good stopping point. Okay, it's not a randomly picked thing. I said, geez, when on March 12th, again, March 12th, remember, right? So March 12th, I said, gosh, 50 is pretty freaking high. Did it go higher? Yeah, it went higher. Went quite a bit higher, actually, but it's not sustainable. Something can go high, and it doesn't mean it's going to keep going high, and that's, again, the physics of the market. How much money does it really take? Look at Apple. You know, Apple goes to 450, close to 500 or whatever. But the physics of it are that now that you're at, you know, given that you're at 450, 475, you are now a $2 trillion company. That means to add another trillion, to go up 50% from 450, you have to add another $1 trillion in market cap. So realistically, where is this $1 trillion going to come from? How is it going to pour into your company? Now, Apple is now the size of the entire Russell 2000. The entire Russell 2000 doesn't add up to Apple's market cap. So all the small caps put together do not add up to Apple. So obviously, if people rotate from small caps into Apple, they cannot affect it enough to drive it up, to drive it much higher. Now, Apple, Google, Facebook, Amazon, whoever, Microsoft, those are all like trillion-dollar companies now. So now the question is saying, okay, well, in this case, now these tech companies, these big tech companies, less than 10 of them, let's say, they are now 80% of the Nasdaq's market cap. So again, question is, where would the money come from to make them go higher? Either it has to come from each other, they have to feed off themselves, or it has to come from the bottom. But the bottom, if you totally removed all the money from the bottom 90 out of 100, you don't have enough money to move the needle on the top 10. So we could zero out the Russell, zero out the rest of the Nasdaq. It's not enough money. The Dow, not enough money, especially if you take Apple out of the, you take Apple and Microsoft are in the Dow. So if you take them out of the Dow and say, now what's the rest of the Dow got? Nowhere near enough to move the needle on. Which means at this point, and it's physics, it's money physics, where would the money come from to move the market any further up? It has to come from the outside. So then you can start watching your inflows and say, is there money flow coming into the market? And if there's not money flow coming in, then that means that you're building a real house of cards as you drive these things higher. So that goes true for anything though. All the markets, there's a certain law of physics, even though financial physics is different, but there's certain laws of physics. There's X amount of money. It can go into certain places at certain times, and you can't create it out of nothing. The Fed can create it out of nothing, but then you're not creating the money out of nothing. The money has to be created by the Fed and put somewhere. Now, the Fed has lately been buying stocks. They've been creating money out of nothing and buying stocks. But instead of looking at that as a positive, you have to look at that as a negative and say, well, geez. So you mean that of this rally, 20% of the inflows have been the Fed buying stocks. So instead of being at 3,300, we'd be at 2,700 if not for the Fed buying stocks. And yes, we would. So you have to, you got to say to yourself, it's like, what's going on here? It's like, well, this is what the money's buying you. But the money can't keep buying this for you. You can see right now it's already starting to buckle under the pressure, because going back to the thing we always talk about, the national debt and so on and so forth, there are physical limits to these things. You might not think there are while you're doing it, but that's the same incorrect logic that you have when you see a guy. Okay, like let's take that Bolt guy who's really, really fast, right? So he runs. I wouldn't know the number, but he runs 100 meters in 6 seconds or whatever it is. So yeah, now I gotta look. How fast is, it always bothers me not to actually know something. How fast is Usain Bolt? 27 miles an hour. Okay, so whatever. 10 seconds. See that? 10 seconds. All right. So here's this guy running less than 10 second 100 meter, right? And you say, oh, whoa, he ran less than 10 seconds, blah, blah, blah. Fine. But can he run less than 9 seconds? No. Okay. Although he ran faster than anybody else ever fast, although he ran 27.8 miles an hour, he cannot run 30 miles an hour. Not if he trains a little more, not if he does this or he does that, blah, 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 blah. He is at the limit of human physical potential in our current form. All right. Now, that doesn't mean it can't get better. Roger Bannister broke the 4-minute mile. Let's see when that was. Okay. And this matters, so bear with me a minute. So Roger Bannister, yes, Roger Bannister, mile, date. It was a long time. It was black and white days. 1954, okay? So that was 4 minutes. First man ever to break the 4-minute mile. And he broke it by nothing, by a tenth of a second or whatever. So now, current, okay, record for record mile. Be a record 4-minute mile. the record for a 4-minute mile is 4 minutes. Record mile, 3:43. We have shaved 17 minutes off that time since 1953. But how did we shave it off? Well, yes, we have done some better things for athletes. We've come up with better training regimes, better targeted muscle, like football and baseball and basketball too. They're very targeted with their workout routines. They specifically develop certain muscles for certain players for certain reasons. There's all kinds of training, electronics, coaching, running techniques, blah, blah, blah. So things do advance a certain amount. But still, in almost 100 years, we have gone from 4 minutes to 3:43. So that's 17 divided by 100. No, I'm sorry, 17 divided by 400. Wait, no, it's not. 17 seconds out of 4 minutes. Frick. So it's 17 divided by 60 times 4, which is 240, right? That's the number. So we've shaved 7% basically off the mile. All right, we've improved it 7% in 75 years, whatever it works out to. So that's how much improvement we made from that. It looked fantastic at the time. Same thing with Usain Bolt. Oh, look at that. Mile world record run progression. How cool. Look at that. Oh, that's amazing. How well does that illustrate my point? No, where'd it go? Oh, damn it. Okay, it's not gonna get any bigger. Anyway, so here you go, 1860. Here's 1950, the 4-minute mile. Boom, boom, boom. Right out there, that's the guy. Right there, he broke the 4-minute mile. And it went down and down and down over there. Now, sneaker technology, things like that. Look, 440 it's at that point. And they're all English. These English people have nothing better to do, huh? Wow, look at that. Isn't that crazy? What is it with the British? Then it goes to Sweden. Isn't that weird, right? And all of a sudden the Swedish figure out a good way to do it. Then you get a couple of Brits back in there, a lot of Brits back in there here. And all of a sudden Algeria and Morocco. That's crazy. Wow, I did not know that it was dominated by the British like that. Anyhow, way off topic now. Physics, right. So look, just because something improves drastically, and again improves drastically, you have to look at what caused it to improve. What caused it to improve? The improvement of shoes, the improvement of workout routines, things like that is what caused it to improve. Also, the popularity of the sport. More people running, more people doing it for fitness. How many people in 1860 ran 4-minute miles for a living? How much of a sport was that then? Then you have to say another thing that happens. What? The airplane is invented. Okay, so here you go, a bunch of people from England who are running around the track at 4-minute miles. They have no competition in the world. So this is how you dominate a sport, by not having any actual competitors. So my guess would be that all the way up here till here's 1911, 18. These still. So all the way up till 1911, 1913, 1915, whatever, 1911. So until 1911, only English people bothered doing this, apparently. So just a guess, but obviously the Greek people ran marathons and things, but who knows what the deal was? I'm not a sport historian. But lack of competition makes it easy for England to dominate. Most likely is this story here. Now, the sport becomes a little more popular, and more people get into it, and people try to break this record. This is a very tantalizing record. Can the 4-minute mile be broken? The publicity of that causes more and more people to try, and eventually this Bannister guy breaks it in 1950. So 50 years later, somebody breaks the record. Now, he popularizes the sport. Now it's a thing in schools where you're always looking for people who can run a 4-minute mile. Now you have a benchmark, and lots of people try to do it. That causes more people to try. That gives you a wider amount of people who may be able to do it. They get sucked into it. Sneakers get better and cheaper and faster, and technology improves and so on and so forth. And then you have sponsors. Sponsors now pay some kid from Africa to go to the Olympic training camp and get paid and have a paid tutoring and all that, and have somewhere to stay, fly around, this and that. That wasn't possible before. The fastest man in the world was a totally unknown person probably for the last 200 years. How would you know he's the fastest man in the world if he doesn't try? How would you know? How do you know how fast a farmer is when his whole life, his whole running thing has been to go from the rice field back to his house? What does that make him the fastest man on earth? So there's factors, and you have to realize though, but underlying this, like I'm saying, underlying all this is the physics of you can't go faster than this. It's not possible. These are just freaking 5-second little bars here. People cannot go that fast. Stocks cannot go that high. It's the same thing. Why? Why can't people go that fast? Because you build up lactic acid in your muscles, because your blood only circulates this fast, because it only carries this much oxygen, because your legs require this much oxygen. You're not built to go that fast. You're not a cheetah. You don't have the cheetah's heart system and respiratory system and so on and so forth. You can't do that. You cannot run 80 miles an hour. You're not built that way. It's not possible. That a stock that's $1 trillion can go to 1.5 trillion, but that doesn't mean it can go to 2 trillion. It certainly doesn't mean it can go to 3 trillion. It just requires too much money and too much import, and you've run out of other things. What's happened in the market is all the normal stocks, the value stocks, the blue chip stocks, had money came out of them, and that money, instead of going back into them when the crisis went over, has shifted to the Nasdaq. And it's a very dangerous shift because it's going to shift away. In order to invest in other stocks, money will come out of the Nasdaq, and it's going to be ugly. Look at it over the long term. So the Nasdaq has expanded from 5,000. It's hard to tell because these are logarithmics. 5,000 to 11,000 since 17. This is from 2,200 to 3,300. It looks the same, but it's not the same at all. This is 50%. This is 120-something%. This is 50%. They look the same, but they are not the same. Don't be fooled when you look at charts. That's why you've always got to do your own math. You got to be very careful because charts are not consistent and are not showing you the same proportions that you expect. The Dow 16 to 27. That's what 50%. That's 50% would be 23. So it's like 60%, 65% for the Dow. That is not 120-something%. See, you guys don't think of it that way because it doesn't look that way because the charts tend to be logarithmic. They're not flat amounts. They are logarithmic scales that try to contain the chart inside the number range. So they'll adjust the number range to make the chart work. And that's a fun and useful dynamic, except when you're trying to make comparisons, because even as I'm telling you these words, you're looking at that and it's hard to get your head around the fact that the Nasdaq is growing more than twice as fast as the other indexes over the same time period. It's hard to get that in your head when you look at the charts and they don't look that different. Okay. This is a 100%, well, here from 2019, that's 100% gain. From this low to here is basically 100% gain. From 2019 here, 2,400 to 3,300, well, 24 and 50% is 36, half. 22 to 27 is only 5, it's like 25%. 7,000, oh, sorry, that's the Nasdaq. 1,250 to 1,500 is what? Is 25, 250, it's about 20%. So 20%, what do we say here? 25%, 50%, 100%. Doesn't look like it at all, does it? Doesn't look like the Nasdaq completely ripped apart all the other indexes. But that's where we are. So what does that mean though? That means money went out of here to here, money went out of here to here, money went out of here to here. Like I said, this whole index is worth less than one stock in the Nasdaq, Apple, which is the stock of the Nasdaq, but still, the whole index is worth less than Apple. You know, that's called putting all your eggs in one basket, right? All our eggs are in the Apple basket. If anything happens to Apple, the entire economy of the world is going to collapse. So let's hope China doesn't ban iPhones. We seem to have no problem banning Chinese products. Everybody thinks it's fun. Fox thinks it's good sport. So if we can ban Chinese products, why don't they retaliate and ban Apple? Well, you know, Apple is one of the biggest employers in China. Tim Cook is really good at keeping those relationships going. He's a good strategist. He's done a wonderful job with the company, actually. He's kept Apple from being a political football, distanced himself from Trump, doesn't back his policies, doesn't talk about much. He's a very good CEO. He's a great CEO, actually, for the time. And we'll see. But still, it's on the table. It's a thing that could happen. China could ban Apple in retaliation. You want to wreck the U.S. economy? Ban iPhones. Call it U.S. spyware and just ban it. And you say, oh, that's ridiculous. Well, what do you think China says? They say, oh, that's ridiculous. How can you say we're spyware? It's one of our fine products. Huawei. It's like you call it spyware just because you don't want competition. It's like, screw you. Anyhow, so Fed buying stock or the debt of companies. The Fed is, yeah, they're buying junk bonds, junk bond ETFs and things like that. But it's pouring money into ETFs, which pushes money into the market. That's what it does. When you're buying an ETF, you're putting money in the market one way or another. You're doing it. You say, oh yeah, we're only buying junk bond ETFs. But when you buy junk bond ETFs, you're putting money into the ETF pool. Who's getting the money? Traders. Free money from the Fed goes to traders. So if they don't keep their J and Ks, they're going to go into something else. It's in their portfolio. It increases their buying power because the Fed is there. It adds money to the market. They like to say that that's not what they're doing, but they are doing that because, in other words, all right, if you have a family of 4, and I give one of your kids $1 million to mow the lawn, and I say, oh no, I didn't do anything to enrich Bernie. I only did something to enrich Bernie's kid. You know, meanwhile, your whole family is going to benefit from your kid getting $1 million, right? It's impossible to avoid. Your family will benefit in some way, shape, or form. There will be more money in the house. There will be more money used. There will be more money going for other things. You won't need to give your kid an allowance. You'll have more money. There's a lot of ways it benefits, even though I didn't give you anything. I only specifically gave it to your kid, but that still benefits your entire family for sure. That's what it is when the Fed puts money into the market. Doesn't matter what they put it into, the money is going to leak out and go all over the place and enrich the people in the market. You know, the person who has J and K in their folder doesn't only have J and K in their folder. They've got many, many other stocks. You've now made them more money. You put money into J and K. You've allowed them to cash out, make a profit, put that money to use somewhere else. It wasn't the Fed's money, right? You say, oh no, the Fed didn't put that money in. The Fed put money in J and K, and then he took his profits in J and K, and he put the money into something else, not the Fed. That's obviously nonsense. It's a bullshit argument. The LTP is up 100% now. When the LTP is down 85%, it wasn't down 85% early in the year. Would you not have been forced to liquidate some positions because of margin requirements? It was managed in a broker account. The answer is no. It was never down 40, 50, 85%. It was down about 40. It was down about 50% of the worst. And at the same time, the STP, which is a hedge for the LTP, was up 100% of the time. So they balanced out. I mean, we treat them as two different portfolios, but more, in an account, they would be the same money, just one goes from one side to the other side. So no, that's why we have the hedge portfolio. That's why we protect it. Exactly for that reason. But yeah, if the LTP was down 85%, that would have sucked, but that didn't happen. Who was down? Somebody was down more though. We took a really big hit. I think it was the dividend portfolio was down not 85%, but it was down like 60%. That was it. And the dividend portfolio, we decided, yes, we had to put another $100,000 to work. In fact, right when we decided that, though, it turned around. But I said, you can't, you had to put money into it because otherwise, how could you adjust it? At that point, we would have been stuck and we would have had to liquidate. Now, another thing about the LTP, though, is because in the LTP, we don't use a lot of margin, but our margin is generally used on these short puts, which we have cut down. We had a lot more short puts and we cut them down considerably, but eliminating these short puts frees up a ton of buying power right away. That's an easy way to do it, is just remove these obligations. So as I was saying though, going back to the main thing here we go. So this was the first set. Let's remember that. So here's what I did on March 12th. Remembering where did we digress? We digress here. The VIX, physics. On March 12th, the VIX was here. I didn't know it was the end of the sell-off. It didn't look like the end of the sell-off. It looked terrific, in fact. Let's take a look. Here's what it actually looked like. That's what the VIX looked like. And I said, when the going gets tough, the tough go shopping. And I was on Money Talk, and we talked about the futures are off 5%. That's their limit. It's very likely we're facing another trading halt. Remember, the trading was halted at that time. Blah, blah, blah. This is already the bottom of the range I predicted on Money Talk. And it's 10%. So I had predicted this would be the bottom of the range at the time. Here's what it looked like, though. This is what these charts look like when we're doing these. When we were making these trades, this is what the chart looked like. Here's both. It's nice. Seeking Alpha freezes your they freeze the charts. They don't have they don't let them update. But if I use the charts the regular way, they live update, so you never actually get a snapshot like this. But Seeking Alpha gives you a snapshot. That's one of the reasons I publish there sometimes, just to snapshot the post so I know where things work. So where was it? So the VIX this is what this morning looked like when I made these calls. The VIX was like this. Boeing was like this. Catastrophe. Cisco. All these things look catastrophic, and people, and of course, all the TA people wouldn't buy this thing. They think it's a falling knife. All right. I'm not a TA person. I'm a fundamentalist. I say Intel. I'm like, are you freaking kidding me? I don't care if it's going to go lower. We sold the $30 puts for $3. 30 is down here. I don't care if it goes lower. I'm happy. What if it does? I'm only worried. What if it doesn't go lower? If it doesn't go lower, I'm going to feel like a moron for not taking this trade. That's what I get concerned about when things are going like this. So look at that. Look how horrific. Every single chart horrific, right? There's not one of these charts that looks investable. Look at Viacom. Oof, what a disaster, right? So that's what we were investing in when I wrote this article. It was this, but you had no idea it was going to turn back. But that's when I put my foot down. And it's not like I do that on a regular basis. I put my foot down that day because I said, this is too low. This is too low. So what's my logic, okay? I go to Boeing and I say, that's crazy. So I don't know for sure we're going to stop falling. So there's a couple of things you have to take into account. Yeah, of course, if we fall further, even though you sell a sensible put, you're still going to get hurt on the margin. So you have to be pretty careful. So Boeing, I'm not sure what March 12th was, but the bottom line, well, wherever it was on that day, I said, Boeing, they'll be close to 160 this morning. So we were here. And at 160, I said, you know what? I think 110 is, and again, how do I do that? Because I could care less what the chart looks like. okay? Because TA is complete bullshit. I said that many, many times before, and I'll keep saying it, and I don't care whether you believe it or not. TA is bullshit, okay? It's exactly as useful as tea leaves. It only tells you what something has done. It doesn't tell you anything about where something's going. And it's useful to find out, to figure out where people are going to make a change. Like, I know this is valid because this is TA, and I know that 75, 85, more like 85 to 90% of the people follow this TA. Therefore, it's a good signal, given a lack of other factors. TA is a good signal I can use to estimate when people are going to change their sentiment on something. They're going to say this is too high, they're going to say this is too low. So I can tell sentiments and make my intermediate trades with that. But value trading, no, that's a whole different ballgame. Value trading, I can give two craps about what this chart looks like. What I care about is when Boeing's at 160, I say to myself, okay, so we've got the 767 problem. We've got the retirement planes are going in. The people are going to cancel their orders. The airlines aren't going to have any business because of this virus thing. Blah blah blah. Factor. Negative. What's going to happen to Boeing over the next 3 years? And then I come up with a number, and my number is I'm comfortable at $90. And then I say to myself, well, what could I do about that? What can I do? What can I do around $90? Well, I can sell the 2022-110 puts for $27.50. Why? That nets me in for not 90, but $82.50. So when Boeing's at 160, I'm not buying Boeing at 160. I'm promising to buy Boeing for $82.50. That's my net. I don't consider that risky. I really want to buy Boeing for $82.50, and I really want to hold it for 10 years and wait for it to come back. I got no problem with that in a long-term portfolio. I am happy to commit. I only committed to 500 shares. It was a wimpy commitment. I wish we had committed a lot more. And what is that? Wait, oh, that's wrong. Look how wrong that is. We are up a lot more than that. I was wrong about this number. Oh, now, no, it's still 1345. It's still a crazy high number. Oh, I see. No, this is still a good trade. So there you go. So the net of this thing is $82.50. It's at frickin' 174 now, and you can still get in there for $82.55. So yeah, keeper. That's why that one's a keeper. How crazy is that? It's at 174, and you can own it for $82.55. So that still is fundamentally ridiculous. That's what makes it easy, though. I'm not gambling. I don't feel like I'm gambling. I don't feel like I'm gambling the same way that if you in a nice neighborhood have the opportunity to buy a 4-bedroom home for $200,000 on a half acre of land with a nice yard and a nice neighborhood and a good school district without you'd be like, well, what's going on then? Is there toxic waste dump? If there's nothing actually wrong, there's a toxic waste dump. That's why it's so cheap. But the toxic waste dump will go away at some point. And then you will be baffled and say, how could it possibly be this cheap? How could the #1 plane maker on the planet Earth be this cheap? Well, they had this problem in the past. Do they still have the problem now? No. Well, then why is it this cheap? Well, because people are idiots. They had a problem. They made a bad plane. They made a mistake. It cost them hundreds of billions of dollars. Do they still have that problem today? No. Well, then, so how come I'm buying this company for whatever? I mean, I don't know what the number is, but how come I'm buying this company so cheaply? BA. So here's the thing. Hey, now you can buy the company for $100 billion. Boeing made $10 billion in 2018. $10 billion. Okay, they lost $600 million last year. They are losing quarterly. Okay, so they lost that. Where's their freaking net income? Interesting. Oh, good God. Why do they make it so complicated? All right, anyway, they lost $600 million total last year. They lost, this is quarterly? All right, then they have a big write-off this quarter, so they're taking 2 billion, 2.8 billion this year. All right, fine. But so that 600 million was net, because if you go back further quarters, oh, here you go. Let's see. See, they had a, well, that's weird. Okay, anyway, so the loss, profit, profit. They did some write-offs, whatever they did. Anyway, so quarterly, 2 billion here. So okay, they lose some money, but the problem is this isn't a startup. Not the problem. I mean, this isn't a startup. They've got $133 billion. What the hell? Really? Yahoo's getting terrible. Good God. You can't even read a Yahoo statement anymore. What do you got to pay for now? Is that what they've done? There you go. Look how sensible this one is. Income after taxes. 10 billion, 8 billion, 5 billion, 5 billion. But this was a development cycle for the new planes. Now they're into a cycle where they should be making 10 billion consistently. But instead of making 10 billion, they lost 600 million last quarter. Fine. Balance sheet. They've got $10 billion in cash. They have inventory. They don't really have any short-term investments, so they're good. So they have $10 billion in cash, and they're not really burning it that quickly. And here's the cash flow. So cash flow from financial operations. So they went down 11, but they paid 4 billion in dividends too. So they can cut the dividend. I think they did cut the dividend, and they can come out of this okay. And we can get into it, but I don't want to get into the whole thing on Boeing. The point is, they're not in that bad of a shape. They're going to recover, and when they recover, they're the biggest plane company in the world, and they're going to make $10 billion on a $100 billion valuation. It doesn't matter what they did in the past. They're not a startup with an uncertain future. They're the biggest plane company in the world, selling something that people need. So you don't want to get, you can't start extrapolating that things are going to go to zero. So it's Boeing. So I'm not saying that, because, by the way, that's at 170. I'm not even saying I'm offering 170. I'm offering freaking 82.50. Half. I'm offering $5 billion, $50 billion for the company that makes $10 billion a year. Do I think they're going to go to $5 billion a year? Are they going to sell half as many planes, make half as much money? No. But that's a ridiculous worst case scenario. I'm comfortable with that then. Maybe they'll have to borrow $10 billion. Maybe they'll have to do this. Maybe they'll have to do that. It all still fits in a $50 billion valuation. So I put my foot down and I say, this is the value I'm putting on. I don't need to be at the bottom. I do need to be comfortable riding this out, though, because it could go all the way down to 82.50. That is my worst case scenario. But I'm willing to buy it for 82.50, so I don't care if it goes down. I don't care if these puts go to $50 and I have 100% loss on my puts, because I really would love to own Boeing for 82.50. That makes me bulletproof. If I really want to buy it, I don't have any downside. My downside is not owning it for 82.50, especially look at it now. My downside is I wish I owned it for 82.50. That's my downside. My downside here at 100 was maybe I'll get to actually own it for 82.50. Now, in reality, what do we do? In reality, we roll the put, we double down on the put, we do whatever. You know, we often don't, because, but then it becomes the same thing. Because then we say, well, okay, I want to own it for 82.50, but I'd like to own twice as much for 42.50 or for 62.50, whatever. Because it's a comfortable allocation. We only oblige ourselves to buy 500 shares at 82.50, $40,000 at Boeing. We have $200,000 of spending power in the long-term portfolio for an allocation block for one position. So again, it's not a stock that's likely to go to zero. So we're not really gambling. We're not really thinking it's going to go to $50 to $25. That's super unlikely. Even Boeing, even with those troubles, is not going to go down to 25 bucks. So what are we risking? We're risking 10. If we doubled it down at $50. So in other words, we're at $82.50 now. Let's say we rolled it to 10 shorts at $50. At $50. What is my risk if I do that? My risk is only really losing half of the $50. It's not realistic to say I'm risking $50,000 because then I'm saying Boeing's going to go bankrupt. And if I think Boeing's going to go bankrupt, what on earth would I be doing selling 110 puts? I get that all the time. People tell me, people ask me in chat and they say, "How?" I say, "Whoa, what is my risk here? I'm risking all this, blah, blah, blah." Don't play it. You got to have a freaking premise that says that the thing's worth something. If you don't believe that, what's the point? And don't go by me. You've got to be comfortable with it. There's 20 ideas in two articles on this thing, and we're never going to get through them all. But no, we will, because I'm just emphasizing this because Boeing's a great example, because they actually do have problems, but the problems were already baked in. This didn't suddenly happen. This whole thing with the incident that they had and all that, it's not what this is about. That's what took them down from a much higher amount. Boeing, not you. Oh, it is Yahoo, though. Chart. There it is. So here's Boeing. Everybody loses perspective. And again, because people don't get their heads out of these freaking long-term charts. But, oh, that looks terrible. What the frick is that? That's completely wrong. Oh, I see, because of, hello, there we go. Ooh, look at that. So Boeing was coming. The Boeing has cycles, and the Boeing cycle is they do a lot of R&D. They come out with the new planes, and when they start selling the new planes, every freaking 20-year cycle. Look, see this cycle? Again, perspective. If you don't look at the long-term charts, if you don't understand the long-term profits of the company and so on and so forth, that's why I use these guys now. I like them a lot better because they have a much longer base to look at. Macro trends. That's why I like macro trends much better, because I like to look back further. I like to go very historical on the profits and really think about like what they've done over the years and what changed and how their business grew and so on and so forth. So it's good to know. Also, you get a view of this crisis still when you're looking at companies with these guys. You can still see the crisis, and knowing how somebody handled the last crisis gives you a good idea how they're going to handle this crisis. So I like that. Anyway, so that information coupled with this, because you forget this, right? You forget that Boeing had a super cycle in the last time they released new planes, and they went flying up. Then we had a crisis, and they went flying down. Then what happens? And they went up even higher. It's funny how the perspective changes, all right? Because again, what happens to the graph? It adjusts itself, it adjusts the scale to fit what's on the graph. And that's a very bad thing, because it makes you forget what really happens with the stock. This stock went from 30 to 100. Then we had a market crash, but then it went back to 150. And then it went flying all the way to 400, because we're into the new cycle of new planes and orders. They were backlogged orders for 5 years in Boeing. They had 5 years worth of orders. They still have 3 years worth of orders backed up. Not that many people really canceled. And as soon as the planes are certified and flying and everything's good again, they're going to be backed up to 5 years again. So they're at max capacity for the foreseeable future. That's justifying this number. They're not going to make just 10 million a year, 10 billion a year. They're going to make 20 billion a year, 30 billion a year. All right. Another crisis, another huge drop, all the way back down to 100. I said, I'll pay 80. 80, this price. All these years back, 80. I'm comfy with that. If it goes to 40, I'm very comfortable doubling down. How much can I afford is the only question I want to ask if it goes down that low. But you've got to do the math. You've got to understand what you're investing in. You've got to buy companies that are solvent. And again, like I said, I think 25 would be completely ridiculous. So I don't consider my risk to be 0. I consider my risk to be completely ridiculous, 25. And therefore, when I sell 5 2022 110 puts, I don't think I'm risking $50,000, and I don't think I'm risking $37,000, because that would mean I wouldn't be rolling. I know what I'm going to do. I know exactly what I'm going to do before it happens. If it goes lower, I'm going to roll my 5 110s to 10 $80 puts, or say, or 10 $60 puts, or something like that, and we're going to net into Boeing for $50. And if I net into 1,000 shares of Boeing for $50, I got $50,000 riding. And no, I don't think it's going to go to zero. I think it'll go to 25 at worst. And that means even if I decide to pull the plug at $25 and I'm down and I've lost now, and I now owe 25,000 off my net 50, I'm fine with that. That's only it's only 10-15% of my allocation block. So what? This is not a risky trade, so therefore it's a no-brainer when I can pick up $13,000 against what I consider a $25,000 risk. But that's because I'm thinking a year, 2 years ahead. I'm thinking of every single thing I might conceivably do in between now and then. And that's how I decide on these numbers. Somebody asked how I decide on these numbers. That's how I decide. I decide based on what I think the company's really worth. Cisco. How does the virus affect Cisco? Not only doesn't it affect Cisco, but think about how many people are staying home and using the internet. That's good for Cisco. That's a stupid one, right? What did I say I would do? I said I will sell the 25 puts for $320, so I'm buying it for $22, $21.80. It's at $32. And I say, I'll pay $21.80. This is not complicated, guys. It's freaking Cisco. Come on. Hanes underwear. Again, and as you know, Hanes was our runner-up stock of the year when we had L Brands was the original pick, and then we split. We picked L Brands in September as our stock of the year because I thought it was ridiculously low at the time. It was like two picks ago or 3 picks ago, and we picked L Brands because I thought it was incredibly undervalued. It finally has borne itself out. If you look at LB now, it's funny. If you look at LB now, people are like, "How the hell did you know that?" But we had a rough couple of years playing them. LB, there's WBA is another one I love. So here's LB now, doing really good. Here's WBA, which I am, hear that, banging the table. Still cheap. Okay, did that with L Brands too. So all I can do is tell you guys over and over and over again that something is cheap. So I have to do that for a very long time, and then finally I get to say, I told you so. So here's L Brands. I liked them for a very long time, and I said I think we started around maybe 40. I don't know if it was 40, but I think it was probably 40. Yeah, here it was. This is when we liked it. I think 17. Was it 17 or 18? What year is this? Well, we had IBM last year, right? And before IBM, it was Wheaton. And before Wheaton, it was L Brands. So wait, IBM, Wheaton, L Brands. Yeah, so here. So it was, I remember it was September. What went wrong with L Brands is because our stock of the year officially gets picked in November. And by November, it had already shot up at Thanksgiving. It had already shot up here. And so I said, oh no, that's not our pick anymore. It was too expensive. So we changed our pick to Hanes Brands, HBI. And that's what was in the other one. So that's what happened. So L Brands did shoot up after we picked in September. It wasn't our stock of the year because we picked HBI. HBI, officially picked HBI, you know, for the money talk. But then we adjusted it out because here's HBI. And see, HBI in November was down at the time. That's why we switched to HBI. And that had a rough time too, but we stuck with it and made money. You know, because we just kept buying more. We said if it gets cheaper, buy more, sell calls, make money, and drop your basis. Now it's taken off again. But so here's Hanes Brand. So we picked it. So in March, of course, since we like it, we watch it all the time. When it went down to $9, I was like, screw that. We got to buy this one now too. What do we do though? We sell the $8 puts for $220. That nets us in for $580. That's a ridiculous price. Happens to be the actual low though. And why is it the actual low? Because I'm not the only idiot who knows how to value invest. There are other people who do the math like I do. There are other people who analyze a company and come up with a target. I used to be an M&A consultant. It used to be my job to tell someone how much a company was worth. I know what a company is worth. I know how to read the books. I know how to understand. I know how to look at the market and value something. So when something is worth a certain amount, when I say a company is getting close to what it's actually worth, I want to jump in. And again, this was March 12th. I didn't know it was going to stop going down here. It didn't stop going down here. I don't care. I'm looking for opportunities, and these were the opportunities I felt comfortable in over the longer term. Doesn't mean they're not going to go down at first. Doesn't mean we won't get a better price, which again is why I always tell people, like, take your price, offer it, and wait patiently. If you get a fill, great. If you don't get a fill, we'll find something else to trade. You don't have to jump on the first thing that comes up. So Haynes stock of the year. IBM, stock of the year. That was the stock of the year last year. So when my stock of the year from last year gets cheap, I'm certainly going to buy that, right? That's a no-brainer. But what do we buy it for? We sold the $80 puts for $10. That's $70. Why did I say 75? That's wrong. That's obviously 70. Anyway, so we're netting in for $70. And again, ridiculous. I'm going to offer ridiculous prices to buy things. I don't mind doing that. If I get it, I get it. Intel. Yeah, and Intel's had a rough time since, but look, we're still in good shape, and that's why that's a keeper, because it's now down again, and it's only up 50%. So we're not getting rid of that. I'm very comfortable with this bottom on Intel, and not really good for a new trade, but it's good. It's like, I'm not going to sit there and take it. I'm not going to cash out when there's still 50% to be made on that one. The biotech ETF. It's only up. It's only up $9,100, but it's a keeper because it's net 14,000 out of 18,000. There's no reason to sell this. It's so in the money, and I'm so comfortable with where we are in that position. It's a, what do we get here? It's a 20-35 spread. Our spread is way down here. 20-35 is our spread. I do not for one second believe it's going to go back below 35. So why would we get rid of it? It's a great trade. Plug, on the other hand, is way ahead of our expectations. 72% up. That one's gone. TD Bank, up 70%. I'm not risking a bank in this environment, so that's gone, even though I liked it at the time. I said it's a very solid bank that's not exposed to energy like other Canadian banks. And they were testing 40 at the time. So here they are, whatever morning that was, they said it was testing 40. So I'm not offering 40 though. I'm selling the 25 puts for $3. It's testing 40 and I'm paying 22. I do not consider this to be risky betting. And frankly, neither did the portfolio margin department of TD Bank, because the portfolio margin on this was very, very small. Tenet Healthcare, THC, another one you guys know we love. What am I doing in a crisis? I'm going to the stocks I love, and I'm making plays that are comfortable on the stocks I love, on prices I would love to be in for. That's all. It's very simple. And people are like, well, why aren't you making a lot of trades now? I'm not making a lot of trades now because these things got much more expensive. I will wait for something to be cheap. Not that, it doesn't have to be that cheap, but I'll wait for something to be cheap. Like Viacom, still cheap. Walgreens, still cheap. Intel, still cheap. This isn't that hard. BA, still cheap. Keeper, says keeper. You want to know stocks to play? Here you go. These are still cheap. These are still good stocks. Our target is still higher than where they are. So here's Viacom. What did we do with Viacom? Well, my first move in Viacom on March 12th or whatever it was so here in Viacom at 1520, whatever it was, or 1850. All right, 1850. And I said, we've done nothing but go down. So I'm going to bang my table once again. 1850 is insane. It's a $12 billion market cap for a company. I don't think that's a difficult premise, right? They made $3.3 billion. They have a $12 billion market cap. They're a broadcast company. They own MTV. They own CBS. They own HBO. Oh, no, they're not HBO. They own something else important. Comedy Central, no, I don't know, whatever. Anyway, they're a huge media conglomerate. They are a pure broadcaster. They're not like Disney with the parks and things. You don't need people for their business. Not just Hollywood people, but not real people. So there's no reason that I can't. And so what am I offering to do? I'm offering to sell the $15 puts. I was aggressive here. This is aggressive. We sold the $15 puts because we were already down here. And we sold the $15 puts for $4.50, but not that aggressive because we're netting in for $10.50. At $18.50, we're netting in for $10.50. It gets another $8 drop. And now they're down to $210. They're up $3,400, but we're killing it because 75% is good. Fine. I don't need to wait a year to make $2,100. I can make more money. I made $3,400 in 6 months. Why would I want to wait 18 months to make $2,100? I can do better. And there's a danger that Viacom could go down. Now, on the other hand, though, in the long-term portfolio, I think this is a long-term portfolio. Yeah, in the LTP, what did we do? We took this short put position, maybe not the same exact one. We had a $17 put. But so on 323, we took a look at this thing in the long-term portfolio, and we said, oh, you know what? Let's do this. It was even lower than it was when we did the first puts. When we did this trade, it got lower, and I said, well, lower. What is my reaction? Is my reaction, oh my God, it got lower, I'm losing 25%? No, that's not how I act, right? It got cheaper, so I bought more. The thing I liked went on an even better sale, and I bought more. I didn't take it back to the store. I said, boy, I really like Viacom. I'll get some more. It was even cheaper now than it was when I bought some. So we sold 10. Then we bumped it up to 30. I'm not sure it was the same put trade, but we did 30 of the $17 puts, and we got $9 for those. We got more aggressive. Notice we went from 50. So Viacom went lower, and we got more aggressive selling the $17 puts for $9. Why? Because that's an idiotic price. That nets us in for 8, the same 8 that we netted in for here, except I said, well, since it's the same 8 that I netted in for here, why not make sure we have more upside? And how'd that work out? Well, we're up 70% on those already. And what else did we do? We picked up the 5. It's almost funny. We picked up the $5 calls for $7. That's net 12 because we were at 10. So we bought these $5 calls for net 12 because people thought this company was going bankrupt. I thought that was ridiculous. And we sold the $15 calls for $3, which is actually not a bad price. Why? Because the VIX was super high, so the premiums are crazy high, and also because there were plenty of people who wanted to just bet. And by the way, these guys did really well. Look how much money we lost on that, 322%. I don't give a crap. That covered the spread. It doesn't matter to us. We have a $10 spread. I don't care how much money this guy makes. God bless him. This is what you call a win-win. I'm happy and he's happy. He gave me $3 so I could buy a $7 call. That is a $4 net cost of a $10 spread. So I'm going to make 250%. He's going to make 500%. I don't care what he makes. I'm making my 250%. God bless him. I hope he makes $1 billion%. What do I care how much he makes on a short call? I'm going to make more. I'm going to have more money than him. I'm going to pay him and keep the difference. So that is a win-win in the market. Okay, everybody wins. The seller, the guy who sold the calls to wins, and I win. The only guy who loses is the put seller. He loses. But he maybe didn't lose either because maybe he owned Comedy, maybe he owned Viacom, and maybe he sold the put to protect himself. And let's say he owned it at 20, and he sold the $17 put for $9 to protect himself, so that he's going to get at least 17 back, even though he paid 29. But still, it's not. What is it not? It's not a 50% loss to him if he does that, right? If he paid 29 because he thought this was a good price, and he buys the $17 put for 9. I'm sorry, if he paid 20. If he paid 20, and he buys the $17 put for 9, that's what I was thinking. So this guy says 20 is a great price. He buys the $20 puts. Then it goes down a little bit, and he says, "Oh God, I better protect myself." So he pays $9 to have me promise to buy it from him for 17. So now he's paid 29 but he's definitely going to get 17 back. That's his logic. But what happens now? So now, even though he paid 29, it's back to 29 basically. It's back to where it is. And now he's got his money back. He's actually happy. He paid me 9. He's net 29, but now he's in pretty good shape and he can go sell calls to some other sucker. That's what's great about options. You don't have to actually lose. It's not really a zero-sum game. It's like people can all win if you construct intelligent trades. And I'm not doing it to do these guys a favor. I could care less, but I'm just saying it's really not as bad as you think. It's not like half these people are getting wiped out. They've all got different motivations for doing what they do. And okay, so that's it for that. So you get the point. It was very simple. None of these, I don't think any of these things are really controversial. Maybe Boeing. I think Boeing is really the only really controversial pick, and even that, I don't have any problem justifying that one. So let's see. So Bernie says, Viacom, what position would you set up today? Didn't we, the one we're keeping? That's what I said, it's a keeper. It's not up that much. Do you expect more downside March on Viacom, for example, in March? Oh, did you expect more? Yeah, I expected more downside because we didn't think, I said right there, I said the rally's got more to go. It's going to go further down. I was worried it wouldn't go further down. We were defensively doing these plays just in case I was wrong and we didn't go down further. Don't forget we had a ton of short puts and we had already cashed out a lot of positions. So we had a lot of cash sitting around. The market had sold off. And I said, well, what if this is the end of the sell-off? Then we're screwed. I didn't want to miss that. So we started selling puts. Did you expect more downside by okay. Oh, but Viacom. To buy a bull call spread rather than going naked calls along with the short puts, going long naked calls. No, we did buy a bull call spread. We bought a bull call spread. We weren't naked long. We bought a spread. We bought a $10 spread for $4. I thought that was a really good price, and I'm happy to do that. Almost any time I see that, if it's a reasonable stock that I think is a value. And like I said, I don't consider the short puts risky in the same way that I don't consider buying a 4-bedroom home in a decent neighborhood for $200,000 to be risky. What are you going to say to me? What if this? What if that? What if a meteor hits it? What if there's a volcano? I don't know what, I mean, I'm going to look at this house and it's $200,000 and it's clearly worth $400,000. I'm going to say, I'll buy that. Could I be wrong? Could something happen? I'm gonna try to figure out why people are pricing it that low. But if I can't figure it out, I'm gonna buy the frickin' house. You've got to know what things are worth. It's not a game. It's not a Monopoly card. That's the thing about these stocks. I mean, to me, these are real things. I'm very much a valuation person. And when I think about a company, I think about everything going on with the company, what it's worth, how much it makes, how much it spends, what they're able to cut, what their cash flow looks like, what their balance sheets look like. I'm thinking of all that stuff when I think of a company, not they sell stuff, It's like, yes, they have cool widgets. They make shiny things. People like them. I read an article that girls really like this stuff. It's not like that. I mean, yeah, it comes into play, but it's not. I mean, I'm thinking about the entire workings of the company, and if I were running it, what would I do? And we had that conversation about Best Buy. I used to run it. I used to manage a stereo store back when I was a kid. I mean, obviously I consult for like tons of Fortune 500 companies, but I mean, I haven't actually run effectively a Best Buy with Dynamite Dave's Stereo Magic in New Jersey, not New Jersey, in Nanuet, New York. And I was in high school, and I used to, I had my schedule arranged in high school, so I'd be out of high school at 1 o'clock, and I would head over there, and I would work and I'd manage the store from 1 o'clock until closing at 10 o'clock every day. So I had a full-time job in high school managing the store, and I was only like 17 years old. And I loved that. It was a great job. It was a great job. Oh, it's so much fun. What a great job when you're a kid. What was I gonna say? Oh yeah. So anyway, so I look at Best Buy, and I just looked at. I think of when Best Buy was down in the dumps, and I thought about their business, and I said at the time, I said, you know, I said what I liked about them is I said, look, they got all this space and they have this thing. I said, what they're doing that's smart is, I mean, as soon as they brought it in, I said, they brought in Samsung to have like a mini store in the thing. Before Apple, they had Samsung. And they brought in Samsung to have like mini stores. And I said, well, that's really smart because Samsung's paying them for the space. And Samsung is staffing it with a couple of people. So what does that do for Best Buy? They need less people to answer questions. They have experts answering questions, making the customers feel like people are taking care of them. Even though they're Samsung reps, they're having questions answered in the Best Buy store. That's what they care about. And they're using up some of their floor space being rented out, and they still get all the sales, not some of the sales. They get all the normal profits. So Samsung's just doing it to push their product through the store. So it's like a brilliant winning strategy. I said, oh, they can expand that. And lo and behold, they did. They brought Apple people in, and they brought AT&T people in, and everybody rents little pieces of Best Buy and pushes their own product. It's almost like a mall. Best Buy, it became like a mall. And it was a brilliant strategy, and it turned them around. Same thing with Bed Bath & Beyond. When Bed Bath & Beyond was down, I understand retail really well. And I said, well, okay, so they've got this and they've got that, and here's their strengths and here's their weaknesses, and they're not as bad as you think. You've got to be able to value something. And if you don't understand the company, don't invest in it. Warren Buffett says that all the time. Do not invest in companies you do not understand. So Bernie says, what do I think the value for Viacom is? It was I forget whatever I said. I mean, let's say 50 billion, right? Oh, not 50 billion. Sorry. I think Viacom at 8 billion is certainly a valuation. I mean, it's right now it's a good valuation. At 16 billion. They're bringing in 3 billion a year, 3 billion a year. Let's say 2 billion a year. So that's 8 times now. All right. What do I think a fair value is? No, we didn't buy it at this price. So we bought it at this price, half. So at $6 billion for a company that made $3 billion last year, did I think that was a good valuation? Was this a brain teaser? No. It's a ridiculous price. It's a price made by people who don't understand what companies do. And remember, I like their CBS All Access product. I said that was going to be a winner. It's turning out to be a winner. Disney came up with a good one too. But even with Disney competition, which is tremendous, even with NBC, whatever the hell that thing is, Peacock, they still did really well with their All Access program. People just apparently willing to subscribe to all kinds of stuff right now. Who's going to last? That's tricky. It's hard to say what's going to happen next. All right. So now that's the first week. Now the second week, things got worse, right? So the second week that we did this, it was March 17th, and here we go, crisis trading again. And here's what we look like. This does not look pretty, does it? But again, I'm not a falling knife kind of guy because I don't give a crap about these charts. I'm a guy who says, whoa, that's low enough. Yeah, we got a virus, we got this, we got that, but it isn't that bad. So I'm willing to put my foot down and say, how low can we go? Okay, I mean, I'm not going to read this to you, but I mean, I'm writing about this stuff and saying this is what I think about. We're staying away. What is it? Since we're back near the bottom of our range, we have a trading range. We're near the bottom of it. We don't think it can go much lower. Why don't we look at some more stocks we'd like to own if the world doesn't end? That's my premise. Let's say the world doesn't end, because we're pricing things as if the world is going to end. So if the world doesn't end, which stocks would I like to have? All right. We're staying away from banks, insurance, and travel stocks. We don't know how bad things will ultimately get. We're going to keep our entries small on the expectation we may have to roll them down, double them down, or both if the market drops another 20%. But here's the kind of bargains we can engineer for ourselves in this kind of market. Be aware that margin requirements can jump if the stock goes lower. So you should have the cash available to actually buy the stocks. Think or swim, ordinary margin is noted for each item. There you go, very simple. So what again? Intel, 30 put for $4, net 26. Where was it? 46. Okay, I'm not being a hero. Apple. This is going to seem kind of obvious now, right? Apple was down here. The June 2022 150 puts for 1450. That's netting in for 135 about. 135.50. 44% off the current price. Where's Apple now? Up here. ADP, that was an interesting one. For some reason, people thought ADP was going to hell. Oh, I see. I should be, I forgot. You should look over here. So you can see what happened here. So Intel went actually down again because of the processor issue, but it's nothing, so it's bullshit. It's a keeper. That's why that's a keeper. Apple, keeper. Why is it a keeper? Because it's got 50% left to go, and the price is ludicrous. 135.50. I have zero worries that Apple is 290. 135.50 is on this chart. You have to go down to this chart to get to 135.50. It's not happening. So yeah, that's a keeper. Why? Because I can make 50% more I'm going to make 50% more for promising Apple. Do you realize right now, somebody will pay you $4,000 to promise to buy Apple for 135.50. There is a person who will pay you $4,000 to promise to buy 500 shares of Apple for 135.50 when it's at 450 for 60, 70% off the current price. If you have margin sitting around doing nothing, why would you not do that? That's the kind of, I mean, that's what hedge funds do. They look for things like that. They're just ludicrous. You know, now, can the world end? Can China ban Apple? Can the market crash? Can China ban Apple and the market crash and somebody atom bombs Cupertino, California? Maybe all those things can happen at once and it'll go to 135. But unless they do, you're going to make your money. Here's ADP. We made 75% of the money on ADP, so why stick around? It's not even doing that good. We just got in at a perfect time. We made 75% on that one. Because what did we do? We sold the $80 puts for 12. The freaking thing was at 100, 110. We sold the $80 puts for 12. That's $78. No, $68. $68. So now it's at 140. So it doesn't matter that it doesn't look exciting on the chart. It's still great. And what was my logic on ADP? You would think people are never going back to work the way ADP is selling off. I doubt revenues will take a hit that is being baked in at the moment, but what I find really attractive is you can sell the puts for blah, 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 whatever. Okay, so, you know, I'm like, this is, you know, I'm like, people are still going to work. You're still going to have payrolls. It's just crazy. Amazon, how obvious was this? Amazon was hiring 100,000 people because they're being overwhelmed by demand, yet the stock was down here. So we did great. The hedge fund did good on this too. I would never pay $1,700 for the stock. That's still over 50 times what they earn, but I don't mind promising there was 17 at the time. I said I wouldn't even pay 17 for it, but I will pay 9. I'll sell the 900 puts for $47.50 and take a free $47.50, which was $4,000 for 5 of them. Wait, that doesn't make any sense. Oh, I see. All right, that's one. So we collected $23,000 for promising to buy Amazon for $900 when it was $1,700. How stupid is that? How obvious is that? But unless, this is why we review these things though, because I think it's going to be obvious again. And I would like you guys to be ready for that. I'd like you guys to say, oh, okay, this is happening again. The world may not end, therefore we can make some money. And it's a lot of freaking money. Caterpillar, always one that we like. Anytime it goes down, we have that song, The Cat Came Back. It always comes back. It's up 80%. We're done with it. Okay, that's the end. That was easy. Clorox, bleach is a simple way to kill coronavirus. Don't drink it because of Trump. It went up, but not, it went up. So oddly enough, we bought Clorox when it was here. I said, we don't have to pay 175. So where was it? It was 175. Or maybe it was here 175. I don't know which side we were on at the time. But I said, we don't have to pay 175 or 125. We can promise to buy it for 110 down here. So, okay, I could see where Clorox shouldn't be going up like crazy because eventually it's still just Clorox, but it shouldn't be going down either. There's nothing bad about it. There's nothing negative, detrimental happening to this thing. That was a no-brainer. And now it's up 80% and we're done. Lockheed Martin, stock of the century. Talked about it for ages because it's the stock of the century. So I guess I've been talking about it for the whole century. No, that's not true. Lockheed Martin replaced what's his name? iRobot. iRobot was our stock of the century. I'm not going to get into that. That's a long story. But iRobot was our stock of the century, and then they sold off their military division, which is my favorite part. So I made a new stock of the century, and my runner-up for stock of the century was iRobot. I'm sorry, it was Lockheed Martin. So basically, there's the start of the century. Now we went from 20 to 80 so far. I don't remember when we did the pick, honestly, but it was whatever. We switched to iRobot. Why did we switch? I mean, we switched to Lockheed Martin. Why did we switch to Lockheed Martin? Fusion. Lockheed Martin is a company that is closest to developing fusion. Sustainable fusion will be the fuel of the future. It'll be the energy source that drives the entire planet. It's going to save the world, hopefully, if they get it right. But if they get it right, they will also be the first probably legitimate trillion-dollar company, not just, they'll be a multi-trillion-dollar company, legitimately. You're talking about sustainable, clean, effectively unlimited energy that will drive all over the world. I mean, it really would be the solution to a lot of our problems. So, and I do believe they will come up with it during the century. I think in the next 20 years, I think we're going to have it. So hopefully, and that'll make a whole big, huge difference in the world. I hope the world lasts that long, frankly. But if it does last that long, we got a good chance of it saving it. And these guys are going to become unbelievably wealthy from it. So that's what I like about Lockheed Martin. And before that, it was iRobot, like I said. And iRobot has continued to do well, even though I got mad at them because they sold their military division, which was my favorite part of the company. So it's somewhere around here that we switched because they were up a lot. They were at a high price, and I said, let's get out of this thing. I'm sick of this, and I'm pissed off that they sold the military division. They went up since, and then they went back down, and now they're coming back down to a normal thing. I do like the company consumer division. I think we have a play in them when they were back at 50. If they go back to 50 again, I'm going to like them again. But that was not what that was about. This was about Lockheed. And Lockheed to me is a no-brainer. Even though in fact, the problem we had with Lockheed was it was consistently up at $300-400 and we didn't want to buy it, even though we love it. It finally came down to a price we wanted to buy. But now we're done with it because it spiked back up again. Medtronic, again, another good stock of the future kind of trade. It's like these are all the replacement parts for humans. You know, when something goes wrong, Medtronic puts a new one in. You know, your heart, your whatever's, they're replacing everything they can. They're working on it. The R&D department is fantastic. They make great devices. What do you think is going to happen in the future? They're going to do more and more stuff. And it's another one that was just kind of expensive. We never really bothered buying it. It took a dip and we jumped right in, but now it's back up already and we're done with it. I still like them long term though. Square. How obvious was this? Square is those little white payment terminals you see in the retailers. It's been a very hot stock and we felt we missed the rally, but now it went down to 40 and it's 50% off its highs as if no one will ever shop again. Not only that, though, I didn't even think about it at the time, but it's contactless. If it's contactless and people can wave their phone at it, that's like a lot of retailers understand their customers wanted that, and a lot more squares have been installed recently. These are the kind of stocks we like. There's no competitor taking them down, just an irrational fear that life will never go back to normal. Square has $2 billion in cash. They made $375 million last year. They can weather a bad quarter or two. It's a very simple premise, right? Because I understand the company. And now it's up 75% and we're done with it. That's all. And we're not done with it because we're worried about it. We're done with it because we can only make 75 cents now over the next 2 years, 18 months. So we're done with it. We got better things to do with our money. Exxon's only up 60%, but I'm not comfortable enough that oil is recovering long term to stick with it. So we're going to dump them. That's the least margin that we're making that we're dumping. It's borderline. I was almost going to consider it a keeper, but I don't really trust the oil and gas industry not to like crash again. So we'll see. But that was easy too because it was stupid. The price went crazy, and it was and the low was the same low they hit after 9/11. So it was pretty obvious that was a good place to get in. And what do we get here? We made $60,000 in 5 months. On very little margin. I forget what the margin was, but it wasn't a lot of margin. So in other words, we collected these. We're all short puts. We collected $81,000. Now we're up 60 out of 80. And we're cashing it basically in. That's it. Great. $60,000 of free cash. Why do we want that free cash? So when the market goes down again, we can buy stuff again. If the market never goes down again, we'll find something on sale. Not that hard. Or like I said, there were just 4 stocks in the first portfolio that was still table banging. Caterpillar, I don't know what day that was. I like Cat as an infrastructure play. We added a bull call spread to the short puts in the LTP. So in the LTP for Caterpillar, I didn't want it to get away, so we added this. And we went with the 15, 100, 120. So look at where we are now. 100, 120 bull call spreads and the July 120 short calls. And it's way up here. Very aggressive, right? But we added that in. It was net 11.7. We sold short puts. Where'd they go? Oh, well, I guess we already cashed them. And upside potential, blah, blah, blah. Along the way, we can sell more short calls, sell more short puts too. And that's where we are with that. So that's not hard. Oh, I'm sorry. No. I see what happened. I'm sorry. That was the original play, and that's what I said to do. Then it went up, and this is what we have. But this is actually still good for a new play also because it's not really profitable. It's like it's only up about $3,000 right now, this play. And it was a, I'm sorry, it's this play. So it was net, the net is now what, 48, 68, 74, minus, oh, it's a credit. It's a $5,000 credit right now, this thing. Oh, I see, because we rolled the call. Okay, at the moment though, this is a credit on the $30,000 spread. So this is a $30,000 credit spread with a $3,000 or $4,000 credit. That's not bad. Would I sell? Oh, would I sell the August 125 calls? No, I would not. But I already said I think that we're going to roll them to the October 130 calls. But those are 17 too, so you're still going to get a nice credit, and then you've got a pretty sensible spread. And I do think Cat's a little bit overrun. I think it's going to come back down a little bit. But again, value, it's the same thing. It's the same thing going up as it is going down. I think this is overvalued for Cat. I don't think we're having this incredible recovery in the global economy. I think this was pumped up in the first place. I don't think this is justified, but I also don't think that is justified. Therefore, I'm comfortable in the 130s. And don't forget the 2-year spread. So the October 130s will roll to the December or January 135s or 140s, and the 140s roll to the 145s, and then the 150s, 160s, and 170. So we're going to keep rolling up, and I certainly don't think Caterpillar is going to go up in the 160s. So at some point, we're going to roll to a position where Caterpillar fails to achieve that position, and we're out. And we have a profit. And then we've still got our spread's in the money, and we collect that money. Presto. It's not hard. And you don't have to take risks. I mean, you know, you're taking risks, but I mean, you don't have to take crazy risks. You just take a sensible risk. You take a blue chip stock. You say, I think this blue chip stock is undervalued. You construct a play around the blue chip stock, and you just wait. And what are we waiting for? $60,000, 75%. We took $80,000 in collections. We are now up $60,000, and the margin on the whole thing was, well, I guess I can go back to the original spread. I bet I noted it there. I hope I did. But it wasn't much, I'll tell you that. So, you know, I know we recently haven't made a lot of picks, but that's because you wait patiently for a good time to do it. No, I didn't add up the margin in this one. That's interesting. I did each time say what the margin was. So I guess we can figure it out. We got look at it, 750, 471, 2,000. So that's like 3,000, 5,000, 10,000, 12,000, 25,000, 28,000. Whoop. Wait, where'd it go? 28,000, no two. So about 30,000 in margin. So for $30,000 in margin, we made $60,000 in 5 months. That's what we did. We collected 80,000. Now we have to give 20 back to get out of them. We're not getting back out of all of them, but we basically have to give $20,000 back, and now we have to wait for the rest of the money. That's all. It's not hard. It's not, I'm sorry. It's not hard if you're patient. It's not hard if you wait for the best time to buy something. It's not hard if you value companies correctly and you don't pay, and you don't let yourself be swayed by people panicking and so on and so forth. But you've got to be patient. And Warren Buffett, I mean, you know, Buffett's an interesting guy because and I think the whole thing is interesting. You know, I'm a very Buffett-y kind of investor. And, you know, and I've listened to him my whole life. Obviously, I pay attention to what he says. He has always said the same thing my whole life, and so was my grandfather, was the same kind of investor. But my whole life, Warren Buffett has told me the same thing my grandfather used to tell me, which is why I started paying attention to him when I was young. Just wait. Markets are going to go up. Markets are going to go down. You don't need to play when they're up. You wait until they're down, you buy sensible stocks at good prices, and you build your portfolio with things that are strong, protected companies with good management teams that are going to grow in the future. You don't need to risk money. In a very, very boring way, Berkshire Hathaway makes 16% a year. It's that compound interesting, right? Berkshire Hathaway annual returns. Oh, come on. Oh, well, be nice to get up to date. Annual returns 2020. I hope that doesn't just give me 2020. Oh. All right, well, hopefully that's, oh no, that's years then. Damn it. Why can't you just have a simple little thing? All right, anyway. So it doesn't look like much, right? 36%, 30%, 39%. This, I mean, that's pretty good. 25%, 57, 6, 35, 52, minus 20, 27, 6, minus 4, 16, 4, 1, 24, 29, minus 32. It's not immune to a crash. 3, 21. Why? Because he doesn't do one thing I do, which is hedge. He doesn't hedge his positions. He basically has longs. He has an LTP but no STP. You know, it's difficult when you're that large to have a short-term portfolio that's going to cover your positions. But well, until 2000, now he's down to 16%. So until 2000, his average gain was 23%. It's not huge though, and this is what I keep telling you guys all the time. Shoot for 20% annual returns and do it consistently, and you will become the richest person on earth. That's all you have to do. You don't have to make crazy bets. You don't have to invest in the latest hot stock. Warren Buffett does not buy the latest hot stock. Warren Buffett skipped the entire internet boom. He didn't own any of those things. He likes companies that make stuff. He likes candy companies. He likes Coca-Cola. He likes IBM. IBM's a computer company, so he has IBM. He has banks. He has insurance companies. Geico is his company. You know, he invests in things that you can touch and see that provide something that people want every day. That's his philosophy of investing. It's my philosophy too. I will invest in tech because I understand tech. I'm way younger than he is. I understand tech better than he does. I don't mind investing. It's not a mystery box to me. To him, it's a mystery box. So you know what he does? He doesn't invest in it. He doesn't invest in things he doesn't understand well. And obviously, when you say doesn't understand it, he understands it a lot better than the average human being. Guy's a genius, but he doesn't understand it well enough to be comfortable making it a top holding of his. He's not going to go chasing after that stuff. He doesn't feel comfortable, so he doesn't do it. Just like, what don't I feel comfortable with? Biotech, right? I generally don't invest in biotech because I'm not comfortable that I understand it well enough to invest in it. I don't invest in junior gold miners. There's a lot of things I don't invest in because I don't want to play with it. It's like I don't have an interest. I don't go chasing after regular REITs. I like the mortgage REITs because they're not. I don't have to worry about their property holdings and so on and so forth. I'm not a big fan of semiconductor companies just because there's just too many little moving parts in it. I said biotech I don't like. I mean, there's certain things I'm not too heavy. Oh, I generally don't like mining companies. They're too crazy. I don't generally like energy companies. I have some favorites that I do like, but I don't just invest in any old one because there's just too much to know. And I'm not going to sit there and pretend I'm an expert in something I don't know. And you're not an expert because you read some guy in Seeking Alpha who said blah, 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 blah. Who knows if he knows what he's talking about? You know, what is that thing? Tip ranks? Is it tip ranks? Yeah. I'll find out analysts. Is that what it was? Analysts, top 25 analysts. Top 25 analysts on tip ranks. Let's see how they are. Here you go. And that's impressive, but look how fast they fall off. He's 84% success, 81% success, 83% success, averaging 20% returns, 30% returns. I'm not sure what time that is. It's probably since they've been on here. So you have these guys in the 80s and 70s. They're the tops. But that's out of here. That's 25 guys out of, I don't know how many. All right, anyway. So these are your best performers in the 70 to 80 range. How much? Where are we on top trades? On top trades, we're around 80% ourselves. And our returns are better than that, but that's because these guys don't, to be fair, they don't leverage, they don't use options. They're probably basically picking stocks straight up. That's really impressive returns for straight up stock picking. I'm not saying I'm better than these guys. They just don't do options. I do options, which gives me an advantage as far as the total returns. But, you know, you look at these guys, this is as good as it gets. And this is only 25 guys out of thousands and thousands of analysts. All right, so when you say Kramer, let's say, for example, oh, you can't do Jim Cramer? Oh, no way. Jim. No? Jim Cramer probably threatens to sue them. That's pretty funny. How about Nigerian? Nigerian. There he is, John Nigerian. Oh, how do we? John has not performed sufficient informative transactions, therefore cannot be ranked. Okay. Anyway, so Nate, it's a good thing to go to tip ranks. I'm not in here. I don't think that I've reported, or I'm not sure how this thing even works. Phil Davis. I don't even exist. That's obnoxious. That's annoying. Davis. Wow. Feel very insulted. I don't know how it works. I'm not sure how you actually get into tip ranks and become a person. But anyway, point being though, that it's hard to pick consistently good stocks. This is 25 guys out of 25,000 that are in the top rankings. And you can't just go by what any one guy says. You don't know how good they are, although you can use that tip ranks thing and find out. If they're a proper analyst, you can get an idea, because I do that a lot. I go to tip ranks when somebody's spouting off some opinion that's being cited in a magazine and starts moving a stock, and I go, well, who is this guy? Does he even know what he's talking about? And then you look at tip ranks and find out they're like below 50% in their accuracy. If you're below 50%, then flipping a coin is as good as you are, or better than you are. If coin's going to be 50%. So 75% is only 25% better than flipping a coin. It's not that much better. Why are we good? We're good because we do something special though. What we're doing is I'm not saying Intel will go up. It didn't go up from where we picked it. It just didn't go down. It's not that Intel went up, it's that it didn't go down. Think about what advantage I have over the average tip rank guy when all I'm telling you is I'm calling a bottom here. I don't care if it goes up. I'm making 60% because it didn't go any lower. Because I'm using the options to our advantage, and we're being the house. That's what this is all about. We're selling premium to people who are the chart watchers, who do freak out about things, and they see Intel down here and they extrapolate that it's going to go down here, and so they're going to sell us the $30 put for $4. And I'm going to say, you know what? I really don't think Intel's going to 26. I'll bet you it doesn't. And here we are, 5 months later, it didn't go to 26. Their margin dropped 60%. The value of that margin dropped 60% because now we've proven, or the market has proven, that Intel really isn't likely to go much below 40. Now it's having retested 45 and it's still not failing, even after more bad news. That does not bode well for this guy's put. And that's how we take advantage of the crisis. We take advantage because we see we've got this run up in price, we have the run up in the VIX, we're getting paid a huge premium, and we say this isn't going to last. So we take advantage. All right, well, that's it. That's our lesson for today. And oh, wait, oh man, come on. Phil, do you think Viacom is fair value? We talked about that. And Phil, can you quickly review the EIA oil report? Well, it's over there, petroleum status report. And it is, I don't even know what happened today. What happened to oil today? Went up a little bit. Okay. So I can pretty much guess what the report is. There has to be a draw of some kind on the oil report. So what happened? Inventories decreased 4.5 million barrels. Is this the right one? August 7th, yeah. Gasoline decreased by a little teeny tiny bit. Distillates decreased also. So everybody decreased. So that's a good report for them. The net decrease is 7.5 million barrels. That's a pretty good decrease. And what did other oils do? Always look for other oils. Other oils only went up a tiny bit. So on the whole, it's a good report. The net draw is like 7. No, the net draw is like 8 million barrels. That's a good net draw. That's the best we've had in a while. So yeah, kudos to them. Did anything really weird happen? Production the same, same capacity-ish, a little bit more refinery capacity, actually. And exports are down, actually exports are down. All right, so there was really some demand. There was really an uptick in demand.